For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Hey, what do you say? Let's manage your financial future, right? Why not? We're here. I'm your podcast host, Johnny Dean, here with Professor Rick Plum, certified financial planner professional and accredited wealth management advisor.
Oh, you're so smooth, even without a cheat sheet.
AWMI. Oh, I know it. When you have the cheat sheet here, it's you've got it. You know, even if you don't use it, it's like a safety net. So, anyway, hey, this is a new season.
That's what I've been told.
I was told that too. I was told that the last week or two they had some
fill in
previously done shows, which that happens every so often as we we reset, and we're back on season. I don't know, whatever it is.
Our voices.
Yeah, this year's just flying by. Honestly, I can't believe it. But we're going to have a couple of different advisors. We're going to try again this season to have an advisor or two. Maybe some surprise guests. We will find out. But anyway, Professor Plum, thank you for being here with me as always. So as I'm doing some research for this particular topic, I had an email from somebody who that linked to another site that talked about how many stocks you should own in retirement.
How many individual stocks?
Well, just how much in percentage of equities.
If it's the one that goes up.
You wish. What's the percentage of equities you should own? And I said, boy, we haven't tackled this topic for a long time. And so I thought, I wonder, and I clicked on the link, and it said, first off, the 100 minus your age rule is a great place to start to find out exactly how much you should own in stocks.
I would have clicked off of that immediately.
Well,
that's
normally
the stupidest thing going.
Well, that's it.
Okay, it may not be the stupidest because there's a lot of stupid things out there.
Right.
But this one makes no sense.
It makes no sense, and they were trying to defend it a little bit, and then they kind of hedged their bets and said, but of course, they brought up the fact that, well, wait a minute, if you actually hit age 100, you should have no stocks. And they said,
and so
obviously,
make sure you sell all your stocks before you get 100. Trigger that capital gain because you've owned those stocks since you were 30, and don't die with them and pass them on to your heirs where they don't have to pay any taxes on them.
So you sell them.
And that, so everybody who is 70 years of age should have the exact same number of stocks. Percentage of their portfolio in stocks, regardless of the size of their portfolio, regardless of their risk or the risk tolerance, regardless of their need. What the heck? Regardless of their tax situation.
Yeah, it doesn't make any sense. And as I was reading this article,
but it was on the internet, so you must believe it.
Well, the people who do believe it, well, I mean, there's an air of authority when you look at it. This is not some blog site. This was a fairly well-known financial type site. And so I was getting upset, as I do. And I said, well, wait a minute. Why get angry? Let's get even. Let's get Professor Plum in here and talk about this. Now, the other side of this that I found is was a very good article. Doggone it. It might have been Morningstar. I'm not sure. Anyway, it interviewed a fellow by the name of Michael Kitces. Now, Michael Kitces is a guy I respect quite a bit.
Oh, very well known, very well respected in our industry.
Yes, and he's done some research with Wade Pfau and a few others, very well respected. And their take was like ours. It says, wait a minute, you may actually want to own more stocks in retirement. And I said, okay, good.
Well, as you get older, you financially, not risk side of things, or not emotionally, but financially
you can. And actually the bucket strategy, if you don't do any value averaging or anything, you just left your bucket strategy alone and you filled bucket 2 with bucket 1 when bucket 1 ran out and you just didn't do anything. I mean, by default, your ratio of stocks ownership to, call it safety, your stock allocation will grow. So Michael Kitces brought this up, and I'm going to throw this at you, Professor Plum, and you can tell our listeners here your opinions of this, and I think I know where you're going to go with this. But somebody asked Michael Kitces in this article from Morningstar, said, well, wait a minute, people should own more stocks in retirement. Why should they own more stocks in retirement? What is the benefit that would lead to better outcomes? And Michael Kitces says, to sort of overgeneralize, there are 4 ways your retirement can go. Now, he mentions these 4 ways, and I'm going to bring these up to you, okay? So scenario number 1 in retirement is that everything is just wonderful, and everything goes up through your retirement, and it doesn't matter really what you do. All of it is going to work, and it's just a matter of how much money is left over at the end. And he mentioned that's like if I started retirement in 1982 and portfolio values increased throughout retirement.
Yeah.
Now, from the start of 1982, for at least 20 years, I guess.
Through 2000.
Through 2000. That's pretty much what happened. So that's scenario number one. Let me run down the 4 scenarios, and we're going to come back to each one.
Okay.
All right. So that's scenario number 1. Everything is wonderful. Then there's scenario 2, which is the opposite side of this. And he brought up the Japan scenario, where everything just goes down forever. It goes down for 30 years. You try to wait out a bear market, and the market never comes back. 30 years later, you're still off 70%. When we go through scenarios like that, well, what he said was, generally, we haven't seen that in this country.
We haven't.
I guess it's a possibility because it did happen in Japan, but they have different monetary system out there, and they have a different way of dealing with things. But that could be.
Yeah, they hit 0 on interest rates long before we did.
Well, they really did, and so that's scenario number 2. I'll let you comment on that in just a second. Scenario number 3 in retirement of the 4 is that you have a bad start but a good finish to your 25, 30 years of retirement, right? That would be something like somebody who retired in the late 1960s. You kick off your retirement, and then you go through the 73, 74 bear market. Inflation hits double digits. You have the worst bond bear market, and then you have this horrible stock market, right? So that's where you have the first 10, 12, 13 years, not real good, and then the rest after that goes very well. So that's what we call the bad start, good finish. And then the 4th scenario is the opposite of that, where you have a great start, but
so like maybe starting in 94, 95?
Yeah. It's like the midnight. Well, he called it like the mid to late 1980s retiree.
Okay.
Right. You're a little ways into the bull market, and you decide that you're ready to retire, and it's great for the first 15 years, right? And then you get to 2000 or so, 2001, and we're making new highs, and then all of a sudden the second half becomes miserable. For the next 10 years from 2000 2010, it does nothing. So that's the 4th scenario. So let me run down you talk about each one of these, Professor Plum, and what you, as a financial advisor, why you believe that owning more in stocks
as you get older can help.
Yeah. So let's go back to scenario number 1 here, where everything is wonderful. It goes up.
Everything just went up and up and up and up. And
Right.
by now, your distribution rate, the amount of money you need to take out of your portfolio, assuming you haven't adjusted your spending along the way, and now you're just spending gods more than what you were when you retired. Your spending is so low compared to your portfolio that I'm not a big fan of spending dividends only. I like reinvesting dividends, but I mean, if you got a 1% distribution rate or even 1.5%, 2% distribution rate, gosh, with today's interest rates and
Yeah.
you can do that. You could have 100% in stocks and be able to withstand any storm that comes up.
Potentially.
But and you've been doing it for a while, and so you don't need to fund 30-some years. You've already funded the majority of your retirement. You started at 65. It's 20 years later. You're 85 years old. Very few people out there need to fund a 30-year retirement from your age 85 on.
Yeah,
it's an unusual time period, so you don't have to. And unfortunately, I say that scenario probably is one of the worst scenarios, because if all you've experienced are wonderful years, you just expect that to continue.
Well, maybe it will for your life. I mean, maybe you never will see. You would have to be very lucky. In our sequence of return discussion.
Yeah, that doesn't happen.
No. But in our sequence of returns discussion, we use this. We've used this one where you retire in 1969 versus 1979. Now, 1979 was just
the beginning,
just a year or so before the really big run up. So if you retired in 79, 80, 81,
through the 80s, through the 90s,
you had a pretty darn good run. You had as close to having everything go up and everything is going to work as possible.
Almost any strategy worked for you at that point.
Yes.
And being 100% stocks, or close to a larger percentage of stocks than 100 minus your age, would have created significantly more wealth. In hindsight, looking back at it.
Yes, you did not know this at the time. And it would have been a risk, I believe, to try.
Oh, yes. But if you're the opposite of Murphy's Law, and everything always turns up roses and just is wonderful, you you plan that way and it works that way. It doesn't work that way for other people.
But it doesn't happen all that often.
But as you get older, you can have more in stocks because you don't need to fund as big of an income in this case, and you don't have to fund 30, 40 years worth of cash flow.
Yeah, and not only that, during that period of time, not only were stocks going up, but your bonds, if you had bought them, I mean,
for a while, you made nothing but money on the bonds as interest rates went down.
Yeah, it was really something. But that doesn't happen very often. So in scenario one, Professor Plum.
Like in that scenario, so now you're 85. The old stupid rule said you should only have 15% in stocks. Stupid.
Yeah,
you could have 50, 60% in stocks again, but I fall back on, well, what am I spending? How much do I need to take from the portfolio every year? What kind of a cash flow am I driving from this that I'm spending? I started with $1 million and now it's $6 million. Before I was taking $40,000, even with inflation. Now I'm taking $80,000, $90,000. It's a 1.5% distribution rate.
Yeah,
you can do that in your sleep pretty much.
Yeah, so in that scenario where everything's rosy, it's that the 100 minus your age would have been a really bad move.
Well, you would have been selling prematurely.
Yeah, which, I mean, maybe you don't need it, but it's up to you. But you would have left a lot of wealth on the table. All right, let's move to the second scenario and get your thoughts on this one that I mentioned, which is the opposite. The Japan scenario is what Michael Kitts has called it. Everything goes down forever. Now, we have never had a period of time, and this was 30 years in Japan, where the markets didn't recover. What is the longest that we've seen in that? 15?
Not even. No, I don't think we've ever had a 15.
Not a 15. I don't mean to talk where it's going down.
I know that the 73, 74 took 12.8 years.
Yeah.
To earn what T-bills were earning.
Yeah, but that didn't mean
back
it didn't
in 73,
recover.
74, 78, 79, 80, T-bills were earning a decent amount of money.
10, 12%, 13% in some cases. All right, so I don't believe we would have a scenario like this in this country, but I guess if you consider that, I mean, if you want to consider all possibilities, that's one that I suppose you could. It's never happened, but
that's the hardest one to deal with.
So how would you, when we talk about owning nothing but when we talk about owning a higher ratio of stocks to bonds or stocks to fixed income in your portfolio during retirement, increasing your exposure to stocks in a scenario like that? There's not much you can do. I don't know that there's anything you can do either way.
So you're looking at it, either you have adjusted your spending down because your portfolio has gone down and stayed down and stayed down and stayed down. And so maybe your spending isn't as high, again, back to the distribution rate. Or you're saying, you know what, we are due for a recovery. So I want to put at least some amount of money, maybe more than maybe you started off with a very secure portfolio and helped you withstand that 30-year downturn, even though interest rates at the time were pretty dismal in that economy. But it's a matter of, A, you're due, B, you don't have to find the same answer as before. Yeah. It's just that your spending is significantly less than what you were hoping for 30 years ago.
You know, I've heard arguments that period that Japan experienced, that long period, was nothing more than a long reversion to a mean that was long overdue. I don't know whether that's true. I haven't done the research for it, but the stock that had become so overvalued by the time we saw the start of that bear market. Again, I don't have the research. I've only heard that. Could be one way to go. Michael Kitts would agree with you. He said, if you have that scenario, I said, frankly, there's not a lot we can do to help. At some point, things are just so horrific for so long, you're going to end up needing to cut your spending a bit.
Yeah, I mean, you don't have a choice.
Yeah.
I mean, back at the original example, we start with $1 million. We're taking $40,000 a year out of it, 4% rule, guideline.
Yeah. Yes.
And now you're 30 years later, and you've had to, because if you were taking 40,000 out, you've run out of money if the market's down 70%, because you've just flat out run out of money. So you've been adjusting, and you've had 30 years of adjusting to this lower number. So it sucks, but it is the way it is. And like you said, it's never happened here.
Well,
and that's probably why a lot of the citizens of Japan were investing in the U.S. Remember in the 80s and 90s?
Oh, it was everything was
owned by the Japanese.
Real estate.
Because they were trying to find return. So, and this goes back to, global investing, hey, a little bit, it's not the worst thing in the world.
You go outside your borders. Well, yeah, and the bucket strategy is designed for about what
it depends on the person. But I was actually having this discussion the other day. It's normally the the default is maybe a 15-year initial time horizon. Bucket number 1 is 7, bucket number 2 is 8.
Yes. For a drop and a recovery.
Right.
Yeah.
To buy enough time to be able to get through, not just to the bottom of the downturn, but
the recovery
through and get
and
up
back.
into a recovery to give yourself a chance where your stock portfolio can earn better than inflation type returns. But I was dealing with I started dealing with somebody 4 years ago, and we did the 14, 15-year plan. They didn't retire. They didn't do anything until 2 years ago.
Oh, boy.
At the bottom.
Yeah.
And can I still retire? And luckily, we had moved some money around. But the resulting plan from 2 years ago wasn't a 15-year plan. It was a 13-year plan because they were already into the downturn.
That's true. No,
So
that's true.
They were through. They were already 2 years into the downturn, and now we're because of the recovery and everything that's happened, we were reviewing the plan and doing things. We're back to we reset. We value averaged, and we're back to a 15-year plan.
Well, and there you go. So these are the kinds of plans. We don't really plan for a 30-year complete disaster scenario
and
like
people
that.
will say, well, I'm 65. I want to see the projections all the way till I'm 105. I'm sorry, I'm not going to do that because there's too many variables. Your spending is going to change dramatically, especially if you're just coming into retirement. You think you know what you're going to spend, but the reality is you don't know what you're going to spend until you get into retirement, until you're 10 years into retirement and you've settled into retirement life. Now we can do more projections, but there's so many things going on. Let's get you into what you expect. Give yourself a cushion so that when you expect X and you get X plus in expending, that you can handle that too. So it's all a matter of and then we'll project out further later on, but not at the beginning. And there's so many different things with the economy. If we started this a couple of years ago, we were dealing with interest rates at 1% and 2%. Now we're dealing with interest rates at 4% and 5%.
Right. That changes the plan quite a bit, doesn't it?
And so trying to project out more. So the idea is project out for a reasonable period of time.
Yeah.
Like we're talking about 15 years. And then look at what the distribution rate is at that time. If you're distributing 15, 20% of your portfolio to keep up with your needs, it's not a very viable portfolio or strategy. If, on the other hand, you've got, you're 15 years into it, you're 80 years old now, and you've got a distribution rate projected based on certain assumptions and all this, and your expected spending habits of 5 or 6%.
Yeah. This is obviously nobody knows what's going to happen in the future. You can only just make certain assumptions.
Life happens in the future, and it
really
changes
does.
your
It
plan.
does. Economic situations change, taxes change. All right, so those are the two.
Ooh, taxes.
Those are the two really big scenarios. One going everything perfectly, and the other
one rosy and one opposite.
One the opposite. So here's something. The next two are going to be the more likely scenario. Talk for just a moment about this one, which is where you have a bad start and a good finish. The person who retires in 1969, we'll say. You have the 73, 74 bear market. You got inflation all through the 70s and all that stuff. Things look really bad for about 12, 13 years, and then they start to recover.
And this is taking everything in a vacuum and taking emotions out of it completely. Because, unfortunately, when things go bad for 10, 12 years, recency bias sticks in. And it's like people are not going to invest. But the reality is that's when we should be investing because, again, hey, we're due, right? But assuming that you're not starting off with the proper strategy, you're just doing a balanced allocation and pulling from there, you're looking at this going, man, I've been distributing a lot of my funds and my portfolio is down quite a bit. You need to recover. You have to recover. You need to be more aggressive. You can't go completely conservative and put it all in cash because then look what happened. To interest rates, it went to zero, and you earn nothing there. And you need to at least have some amount of money in stocks. Probably more is better at that point when it's been down for 10, 12 years because you need to be exposed to it when it does recover. All
right, so talk about how you would have set somebody up in let's say 1969. Now we had an example of $100,000 invested, but talk about what you would have done to somebody.
Well, the good news
as the bad times are going on.
The good news is that a properly done bucket strategy, so you're referring to a study that John Hancock did between somebody retiring in 1969 with $100,000 and deciding to take $5,000 a year out of their portfolio, a balanced portfolio, 50-50 stock bond mix.
Yep.
And unfortunately, by doing it the way they did it with this balanced portfolio and pulling $5,000 a year out of it, They were out of money in 20 years.
Because of the bad...
Because the first 10 years had 4 negative years. And a couple of those negative years weren't even very bad. They were just like 2 or 3% down on overall. And then comparing that to somebody who retired in 1979, who did the exact same thing, $100,000, $5,000 a year, no inflation adjustment on the distribution. And then being able to, what did they have after 20 years? They had like $500,000 left after 20 years because they experienced a good year. So if all you had done is properly bucketize yourself at the beginning of the period, 1969, you would have not had to sell your assets when the market was going down to create the $5,000 a year distribution.
Do you recall what you do? You actually bucketized that.
I did a very simplistic.
Do you recall?
I remember. Oh yeah.
Okay, so what did you do? Just in the next 60 seconds or so, what did you do for that?
I went and said, okay, I'm going to do 10 years of my distribution, and I'm going to put it in the mattress. Or
no rate of return.
No earnings. And so if I'm taking half the portfolio, $100,000 starting portfolio, half that's $50,000, putting that into the coffee can, putting that in whatever you want to call it, and taking $5,000 a year out of it, it lasts for 10 years.
And your coffee can
and my coffee can is empty. And then 10 years from now.
Now you're 100% stocks after.
I'm 100% stocks after 10 years.
A very bad 10 years.
What people consider a bad 10 years. I take $50,000 out of the portfolio at that time and put it and refill my coffee can.
Wait, after 10 years.
After 10 years.
So you're going to sell some of those stocks.
At that point, I sold the stocks. I mean, I'm not doing any value averaging. I'm not doing any market timing. I made a nice round number.
Yeah, I understand.
I split the portfolio in half. I put $50,000 into that same portfolio that they'd used that actually ran me out of money in 20 years. And so on the surface, I became more conservative because I put $50,000 into something that had no risk. I put half the portfolio in something that had no risk.
Well, where were the stocks after 10 years? I mean, you put
the stock portfolio.
You put $50,000. You let it sit there.
I don't have that number memorized.
Roughly. Was it more than 50,000?
It was more than 50,000. It was definitely more than 50,000.
Okay.
But I don't think it was 100,000.
All right, but you took now you took the.
I think it was in the 70. Something in the 70,000, 80,000.
All right, so what did you do after 10 years?
80,000. At the end of 10 years, I took 50,000 out of the portfolio, put it in cash, and gave myself another 10 years of $5,000 a year, just like the initial scenario had done.
No interest. You're back in the coffee can.
Yeah, back in the coffee can. No earnings at all, even though back in 1979, we could have earned quite a bit of interest on that coffee can.
Right.
But what I looked at was where was my portfolio at the end of 20 years? Where in the original example, using the portfolio as a whole,
yes, I
was out of money in 20 years. At the end of 20 years, being half as aggressive.
Bucketizing it,
right,
in other words.
I had $102,000 left.
In the stock portfolio?
Well, in the balanced portfolio. There was a balanced portfolio. It was 50-50 stock bond mix. But obviously, I had more in stocks 20 years later because I still had stocks.
Yes.
I mean, in the first scenario, which was started with 50% stocks and everything, I had 0% stocks after 20 years because I had 0% anything.
You had no money.
I had no money left. But this way, I still had, I had 50% stocks because it was a 50.
Okay,
50%.
so.
But the reason being was I was able to miss the negative year, the selling in the negative years. I didn't have to sell, which meant that the assets that went down had time to recover. And when they recovered, then I sold them. So it's just a matter of buying time. So that was just a very basic bucket. So doing it correctly helps a lot of these issues, takes a lot of this guesswork out of it. And that's why we subscribe to the time segmentation theory, the bucket strategy.
Well, see, what you did there, Professor Plum, was you actually owned, during that bad period of time, as a percentage of your holdings, more stocks
right.
as you went on between 69 and 79, between 79 and 89.
Right.
So there you go, owning more stocks. Okay, let me switch over, if I may, to the other scenario. And I tell you what, that's very powerful stuff you just said. I hope people can visualize what it is we're talking about here. You owned more stocks during a very bad period.
And I was able to not sell the stocks. I think that's the most important key.
There's your key. So,
I have to be able to avoid selling when the market, not in individual stocks, because individual stocks can go down and never recover. Markets, especially the U.S. market,
yes,
it can go down, but it will recover. Otherwise, I guess none of this matters anyway.
So the last scenario, which is what we call the good first and then the bad, like the mid-1980s. You're a little ways in the bull market. You're ready to retire. Retirement is wonderful for the first 13, 14, 15 years. And then here we are, 14 years later, you hit 2000, and it's a miserable second half of your retirement. Now, the interesting thing is the good and then bad scenario is the one that most retirees are afraid of occurring. Because they
good than bad?
Yes. If you have a wonderful first 15 years and then after that, things are horrible.
I'm more afraid of the bad first 15 years just because of the emotional toll it takes on somebody.
But here's why they're more afraid of the first good 15 years and then a horrible 15 years is because they say, well, if I have to, I can go back to work when I'm 65. And I can, but I can't do that.
I'm 80?
If things are awful when I'm 80 and everything turns down and my money drains out, I've got nowhere to turn. It's the point of no return is what they said. So this is why they're afraid. Professor Plum, in that scenario where you have the first 15 years really good of your retirement and the second is rotten, how does owning more stocks in retirement, how are you helped?
Well, I mean, the good news is unless you've increased your spending along the way, if you have the same basic spending you had before, again, your distribution rate is so low that you can afford to have the stocks go down 15, 20%. You're giving yourself time to be able to recover those ultimate bad years in the future.
You've owned more. You've had 15 years of good stock ownership, which
you've
means
got a significant amount of stocks in your portfolio now. If you started off with, in the example we played with before, where I took 50% of the money and put it into savings, I did the same thing for the person that retired in 1979, and that ended up with like $500,000 in their portfolio in 1999.
20 years later.
20 years later. Instead of being broke, they had 5 times the amount of money. But they could afford to, because they're only taking $5,000-$10,000 a year out of the portfolio. That's 1 or 2%. They can afford to have 50, 60, 70% in stocks, even though they're a lot older, because they can afford the volatility because their distribution rate. This goes back to spending. And that's why 100 minus your age is stupid, because it doesn't do anything about what you're trying to accomplish with the portfolio. It doesn't go into, and this is why I'm not a big fan of this particular setup, because it completely ignores the emotional side of what's happening. If the markets are down, people tend to try to sell, and that's when they actually should be buying. Mm-hmm. When the markets are up like crazy, people want to buy, and that's when they actually should be pulling back some of the risk and having more money in safety. This is, your retirement strategy is a living, breathing thing. It needs to change as things change. It needs to adapt. It needs to look at what's happening.
And it will.
And take advantage of what's going on, protect against what's potentially going to go on.
Well,
but it's just a matter of, if it goes great for 15 years, by the time you're 15 years into it, your stock portfolio is probably a lot more than it was. And I will say you should be maybe selling at that point just to protect yourself. Take advantage of that up market. Take advantage of that better than expected return.
Here's how Kitsis described it. He said, if you get the scenario where things are good in the first half, he said it doesn't matter how bad the second half of retirement is. If you're taking a modest withdrawal rate all along, as you just said, you really can't fail in the second half. You could diminish how much money you're going to pass on to your kids. It affects your legacy, but not your actual retirement income sustainability from where you started. That's why you should really not fear that particular scenario if you're properly bucketized.
Well, even in his situation where I don't think he's using buckets, you're going back to the John Hancock study.
Yes,
the person that started with $100,000, 20 years later, retiring in 1979, they had $500,000
systematic withdrawal
with a systematic withdrawal approach, because everything worked fine. And then 10 years after that, going through the 2000 to 2010 horrible time period, they still had $600,000 left over at the end of 30 years.
Well, to wrap this up, what he says is he jokingly labeled this heads you win, tails you don't lose outcome.
Okay.
He said if we get the bad first in the good scenario, the rising equity glide path helps us, which is true. You said that. We own fewer stocks in the bad years. We dollar cost average into the good years. Now, if we get the opposite, we get the good and then bad sequence, basically all that happens, he said, is we own a little bit less of wonderful return stocks along the way, and we leave a little less money to our kids, but we're not in danger of having a retirement problem. It's not like we're going up to 100% in equities with the tech crash of 2000. That would be scary. All right, so that's the scenario.
Right. And so the amount of stocks you have is not determined by your age. It's determined by your goal, your need, and your tolerance for volatility.
That's it. And
That's
the tolerance for volatility is really the behavior kind of
right.
thing.
And how much you have to tolerate is directed by your goal. Because if you've got a very high need, then you're going to have to tolerate some volatility.
Now, this does not mean, as we wrap this up here, this does not mean that everybody in every scenario should own more stocks in retirement. I can't think of a, but
you shouldn't sell them just because you're getting older.
There you go.
The age is not a determining factor on the amount of stocks. Goal, need, distribution patterns, those are the things that are important when determining what your overall allocation is.
And risk tolerance to the extent that you just don't like seeing.
A 90-year-old can have a much larger percentage of their portfolio in stocks, this is purely financial, not emotional, than a 65-year-old who's getting ready to retire. Why? Because that 65-year-old is looking at 25, 30 years of distribution, and they don't want to have a bad sequence of returns screw it up. The 95-year-old has 10 or 15 years, maybe, of distribution.
Maybe 5.
Who knows? They don't have a 30-year distribution. They can afford to put some of the money.
Well, this is how Michael Kitces wrapped it up. He said, well, because at that point, when you're that age, you've already gone 15, 20, 25 years into retirement, so you don't have the time.
Okay.
Well, there you go.
It kind of makes me feel kind of good that I think kind of the same way as...
That's why I printed this and brought it up. Yeah.
He's very well respected in our industry.
Well,
very well written. He does a lot of the studies that we rely on.
Yeah, and I wanted to bring this up. So that's why I got my goat when I knew if I could bring you in...
100 minus your age.
Please. That's right.
Well, but that means somebody who's 40 should have 60% stocks and 40% bonds.
It's just...
Not for retirement.
No.
That's stupid.
It is stupid. All right. Well, anyway, if you want to know more about this stuff and you need some help with it, maybe you're not sure exactly. You say, well, I've just started retirement. What's a good percentage of stock ownership that I should have? Everybody's situation is different. You talk to somebody like Professor Plum or any of the Lucia Capital Group advisors. They do this stuff all the time, and they love it. Is that Maxwell Smart? Did I say it correctly?
Missed it by that much.
That's right. I'm determining an asset allocation and loving it. 800-644-1150. Give them a call at Lucia Capital Group, 800-644-1150, or go online, luciacap.com, luciacap.com. I mentioned also at that we have a bucket strategy guide. We have a Social Security decision kit you can get there. Somebody asked about a Medicare thing. I don't think we have a Medicare.
I've never written one.
No, and so I hope I didn't say that in some, but we had a lot of people asking us about that. Hey, I heard about a Medicare. I don't think I said that. If I did, I apologize. But anyway, a Social Security, we have an estate planning guide, and we have a retirement guide, a buckets guide to explain bucket strategy. Go to luciacap.com, type in bucket strategy in the search field, type in estate planning if you want that, or type in Social Security.
I had somebody call and say they couldn't find the bucket strategy because they were putting buckets, plural,
I saw that,
into the search bar. Just put bucket.
Put bucket or bucket strategy. We got to change that. That's
singular bucket strategy.
We should make that a little easier.
Because there is only one correct bucket strategy.
You are correct, sir, with a little registered trademark right after that, Lucia Capital Group. My thanks to Professor Plum. Don't forget to subscribe to this podcast, Managing Your Financial Future. Listen to every single episode, and you will not be sorry. Apple Podcast or Spotify, that's the way you go to do that. Thanks, Professor.
Anytime.
We appreciate you. You're a good guy. You really are. For Professor Rick Plum, Certified Financial Planner Professional, I'm your podcast host, Johnny Dean. Thanks for listening. Talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. An asset allocation strategy does not ensure a profit or protect against loss. You should always seek counsel of the appropriate advisor prior to making any investment decision. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. A value averaging strategy does not guarantee a profit or protection from loss. The investor sets a target growth rate or amount on his or her asset base or portfolio each month and then adjusts the next month's contribution according to the relative gain or shortfall made on the original asset base. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial, inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial. The people and companies mentioned in this podcast are not affiliated with or endorsed by LPL Financial or Lucia Capital Group.